that's tax day in some countries, whatever tax is. The Brent crude oil is trading this morning, I would say again, little changed at $65 a barrel. It seems to be the new rock that this oil price barnacle wants to stick on. Let's kick off this morning in Denmark with Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, we saw the OPEC Plus report yesterday, again downgrading global oil demand growth this year, still way above the average, but nonetheless downgrading it. What do you think is keeping this oil price stuck where it is? It seems after the drama of recent days and weeks, we're kind of found a place we're stuck at.
Yeah, good morning, Sean. I think basically the market is trying to work out what price basically will reflect the new situation that we have. Probably also some realization that I think was one of the major oil companies the other day saying that $60 basically reflects a non-growth, a year of non-growth in demand. So that's probably a bit too much to the downside at this point in time. I think also the dramatic selling we've been through in the past couple of weeks, quite a bit of that has actually been driven by macroeconomic focused hedge funds or traders basically looking for a hedge against recession, because we saw the bond market play up last week, basically at least temporarily losing its ability to act as that guarantee, and I think that has led to some selling in the oil market, which is now being slightly reduced. So I think we are 65 seems like a good level for now. At least the average price last year was around $80, so we're already 15 down on that, and we still basically need to see what the incoming data tells us in terms of a slowdown in demand. I also note that Chinese imports last month was very robust, so we're not seeing in the actual numbers just yet this pain that the market is trying to price in.
Russell Robertson, Chief Commercial Officer at the Gulf Mercantile Exchange. We got a sense there from Ole of demand, but where is supply at? I think the question is market possibly also digesting as OPEC Plus moves into this ramping up of supply. And we've reports yesterday with the OPEC monthly report that Kazakhstan still 400,000 barrels above their commitment level. Where is supply at, do you think?
I think it's definitely still slightly above what we're expecting, but I also think that some of these numbers that we're looking at for OPEC supplying additional barrels to the market is probably, when you actually work out the additional barrels that are coming out from them collectively versus what is already in the market, there's not a huge amount of difference. So I think this is one of the things that people are trying to actually work out is what is the overproduction of supply, which we're seeing in maybe 3 or 4 countries. Which I'll let you speak those names, but it's ultimately that's still being digested, and I think a good point Ole made, which is the Chinese demand is clearly robust, and the refineries are still working out where to bring it in from. I'm more interested about the product market at the moment and how these tariffs are hitting that, particularly things like LNG and LPG and some of that type of stuff, how that's going to change the flows a little bit, but. Yeah, it's
what's the divergence there, Russell? Why is that of more interest to you? Is it because you list those contracts on your exchange and that's what makes you money every day, or
no, not so much. No, it's just so LPG. 50% of the Chinese imports come from the US. So with these new potential tariffs, I would call them potential because we don't know how far Mr. Trump's going to walk backwards yet, but. That you've seen the price of LPG go up significantly recently. So that's going to have to come from somewhere. If you look at the Middle East, which is what we talk about, Saudi is the biggest producer of LPG, but they're a big consumer themselves. And then you have Qatar and Abu Dhabi are also second and third biggest producers. So if the US starts impacting refining and export volume based on tariffs and they just become uncompetitive, then what does that mean for the Middle East? I think it's probably another story that tells us that China and the Middle East and probably India are going to get closer to each other.
Daniel Richards, Middle East and North Africa economist at Emirates MBD. Another question that maybe is out there in this oil price stuck at $65 a barrel is how much pain can these Gulf states absorb and hold this line? I mean, Russell referenced there how much pain, how much can Trump hold the line on his tariffs? And we're already seeing him walk it back in every which way he can, it seems. But what about OPEC Plus and the main decision makers there, particularly Saudi Arabia, the biggest exporter within OPEC Plus, the biggest economy in the Gulf? How much can they absorb this policy of increasing supply into a demand weakening macro global economy and see the oil price hover way below where they need it for budgetary purposes?
Yeah, sure. Obviously, within the GCC, very different break-even levels, but like you say, the main decision makers, namely Saudi Arabia, has a much higher break-even level than the rest. And we just revised down our average forecast for this year. We were at 73 from the start of the year. We've gone down to 68 for Brent. I think Q1 was around 75 in line with our Q1 forecast. But you look at the kind of demand picture and those questions of supply, and the trajectory seems to be weaker than it was. For Saudi Arabia, we are in the process of probably putting something out today of revising our projections for Saudi Arabia, especially around the fiscal space. We had a budget deficit closer to 5% on a previous outlook. Now we're looking more at like 6%. So I think we're not even the widest with that projection. So for the time being, they can absorb it. They've made quite clear that they expected to run budget deficits for the next several years. They came out with traps very quickly last January with some pretty aggressive issuance. We saw exactly the same thing happen this year. And while there's been talk of recalibration of some of his projects, they're still committed to a lot of these. A lot of these have timely pressures on them to deliver in terms of these big international events. But the longer than this goes on for, then I think the more we're going to start to see more headlines about some greater recalibration. So for the time being, we think they can absorb it, and they seem prepared to, actively willing to absorb it. But it's not something that can go on forever. If it carries on at these lower prices, which probably will, given what's going on, then we would expect maybe there will be greater retrenchment of some of these bigger projects.
Ole, looking at the sort of why of this, I mean, this policy of OPEC Plus putting more crude oil on the market at a time when clearly global demand and global economies are facing multiple headwinds, it does seem to be a departure from recent years' strategy of, as they would say, balancing the market. Your thoughts on what's driving that strategy, and is there an unending sort of outlook for that?
Well, obviously the first and most obvious answer is based on what they said themselves, that they are somewhat frustrated with producers within the group not producing above quota. That is now starting to be reduced. But there's probably two other factors. The increased sanctions, I would say, against Venezuela and Iran. We've seen how these two countries have increased production quite dramatically in the last 4 years. Perhaps some speculation that could be impacted in the coming months. But then also, I mean, you just have to look at what has really led to this kind of failure of their strategy in terms of getting prices up has been the high price has been inviting in increased production from non-OPEC plus producers, and you can't help thinking a bit that might also be one of the strategies, simply that we are now down to levels especially in WTI, and if you look out the curve, we're trading around $60 there. That is simply not a level that's appealing for producers, especially some of the prolific shale areas. So we will, over time, if these prices stay at these levels, we will over time see production start to be impacted. Probably not so much in the coming months, simply because quite a lot of this production is hedged in the futures market. So we have to wait until some of these futures hedges start to roll over or roll out, and then the negative impact really will be felt. So I think it's a combination of several things, and also just simply acknowledging that the global economy right now is a little bit fragile, and simply trying to add to this fragility by keeping oil prices too elevated doesn't make sense either. So I think they basically come to the solution, going through a short to medium term period of pain with and then basically potentially reaping the benefits later on.
Russell, just looking at that point, the sort of composition of the global supply. We've seen, obviously, as we're saying, OPEC looking at increasing, but there's sanctions on the likes of Venezuela. We've seen in recent months the unusual circumstances where Platts Dubai, the sour crude east of Suez contract has trading at a premium above WTI, and Brent, the sweeter crude, the more valuable crude usually. What's the dynamic there these days? What's the outlook for that to continue?
Yeah, currently the trend is flat. We're not seeing any change in that spread. I mean, Brent's trading $1.20 under Oman at the moment as we speak. So that has been quite consistent for the last few weeks. Even with all this volatility, we haven't seen much change in the spreads. So that trend had already started some time back.
Who
And I
can
think
take
it's more-
advantage of that? Who wins from that? Oman? I mean, where can that, is there a way to see that correct itself? Is there any suppliers that can come in blending? How does that resolve itself?
So Oman is a very balanced market, right? So it's limiting how much the actual Omani crude oil barrel can change things. The current economics we're seeing and the demand in China is positive for Middle East crude and more the medium sour barrel. The more sweet stuff is a lot more supply, for one thing, we've seen recently. So Murban into Asia has grown. WTI into Asia had grown, but we suspect that's obviously going to drop now a little bit. But even though not significant numbers, but that was expected to get to 200 KBD this year, but unlikely now. So that and then the impact of WTI going back into Europe to set the Brent benchmark is obviously something that's having an impact on that too. So there is an oversupply, I would say, of sweet. So it's just a fundamental move in the sweet sour spread, to be quite blunt. But we're not seeing anything that's changing at the moment. I would say Murban's pricing below Dubai on a regular basis. Brent is trading below Oman on a regular basis. So the dynamics of that is here to stay for the time being. The curve is quite flat.
Daniel, you mentioned there in your earlier comments the deficit that you're moving it from a 5% budget deficit to a 6%, which means perhaps they have to borrow more money or some way fill that gap. But what about growth? What about GDP? How is the Gulf states? I mean, they've got a double whammy now contending with the lower oil revenues and the budget deficits, but also the tariffs and potentially global trade slowdown. How is the outlook from Emirates NBD's view on the Gulf GDP, the health of the Gulf states' economies, which have been somewhat thriving in recent years?
We're started pretty strongly to start the year, at least. We haven't made any sizable revisions to our growth forecast. When you look at the non-oil performance, especially so far from UAE and Saudi Arabia, UAE slowed a little bit on the last PMI survey, 54 down from 55, but Q1 generally holding up pretty well. You look at Saudi Arabia, January PMI survey, highest in like 14 years, and still at around 58 level the following 2 months. When you look for the rest of this year, we remain pretty bullish generally. There's massive projects going on in both countries. Everything's going on in Saudi Arabia, everyone well knows. When in the UAE, you have the airport, new metro, railway line, etc. So that should underpin growth. One thing I guess we would be watching, obviously trade and logistics. If there's a significant slowdown in global trade, potentially less coming through Jebel Ali or the major airports here, that could be an impact. And then tourism as well. If suddenly there's another cost of living crisis, and there's a marked slowdown in households' ability to spend, and that could impact as well. But at the same time, you look at Dubai tourism figures, again, holding up pretty well so far this year. There has been a bit of a slowdown in growth. That's almost all driven by a drop in visitors from South Asia, which is related to more stringent visa regulations. When you look at visitors from other source markets, still pretty strong growth. And if its weaker dollar continues against the euro, against the pound and some other key currencies, could even make it more attractive. So for the time being, we don't see any particular threat. And in terms of direct impact of tariffs, so you have the 10% now on the GCC, it was 10% already and now 10% for everybody. It's a pretty slim impact on direct trade to the US. For UAE, it's around 2%, I think. Most significant is aluminium with 25%, but that's only like 0.4% of total UAE exports. Saudi Arabia closer to 5%, but that's almost all oil, which isn't in sanctions, so it isn't being tariffed. So generally, the direct impact hasn't been that acute either.
Ole, looking at sort of a wider kind of lens on the commodities and taking, the tariff outlook here, we have the U.S. Treasury Secretary in Argentina today, and Argentina's just done a deal with the IMF, a bailout package, some big numbers, $20 billion from the IMF to and an additional 10 from the World Bank. And the American interest into Argentina, very keen, in South America as a whole, as expressed by the Secretary of Treasury today, because they want to try and tackle the Chinese footprint into South America, having lost in Africa, and hence to the rare earths and all the other commodities and minerals that are so critical with the new digital economy. I was wondering, as we sort of enter the foothills of this trade war between China and the US, are we seeing any sort of developments in the wider commodity space that are giving us signals as to where this may go, how long it may last?
Not really yet, because the initial reaction that we had past that Liberation Day announcement and then the flip-flopping on the tariffs has obviously been an initial move to a lower risk across the board. So that triggered some quite significant weakness, which is now being pared back. But the dust hasn't. I don't think the dust has settled quite yet. We are seeing some sectors obviously benefiting from the weaker dollar. The grain sector is one of them, where corn price is actually the best performing commodity this month, outgunning gold, which has received all the attention. But I think even industrial metals are also showing some signs of life, and I think that's probably also partly due to the expectation that if this goes and get any worse, then China will have to do something domestically in terms of adding additional stimulus, which could be beneficial for some of these, especially the transition metals. So I think the market is very much right now in a bit of a wait and see mode. The initial panic has been taken out, and now we just kind of try to navigate through this daily change of daily news flow, which tends to be changing on a regular basis. One thing that obviously does stand out is the gold market rally, which is in the second year now, very, very strong move up, more than 23%, clearly indicating that all is not well. And that really
Goldman Sachs are calling now 3,700, currently exactly at around 3,200, 3,300.
Exactly, and that remains the canary in the coal mine, and especially when the bond market is having its own problems right now, especially in the US. So this is really where we need to be focusing, because the continued bid coming into the market does indicate that this is not all just the momentum; it's also real money that's being allocated, and there is some flows away from dollar-based other dollar-based assets. So that's really one I will keep an eye on, and then perhaps from an investment perspective, see if some of the minor investment metals start to gather some to pick up again after having been beaten down quite significantly during the initial phase of that sell-off.
Russell, sitting in Singapore, where you spend a lot of your time, the Singaporean Prime Minister has been quite vocal about this US tariff policy that has come on everybody in the last few weeks, and he's obviously been expressing some grave concerns about it and the abandonment of the rules-based system and so forth. I'm wondering, from sitting in a Singapore perspective, and Singapore being I'm a bit like speaking of the analogy, the cuckoo in the coal mine. I mean, Singapore is very much that within the context of the health of the Southeast Asian economic outlook. What does this all look like from there? How grave or how significant should we take his comments? And they are quite alarming. That typically Singaporean prime ministers are quite silent on times like this.
Yeah, Mr. Wong did come out with some very explicit videos, but I think if you look at them, they are quite sensible.
I first checked actually to see if they were some kind of an AI fake, but they turned out to be real because it was so unusual, you know.
Yeah, it is unusual. But if you listen to what he's saying, he's trying to, I think, settle people down a little bit, which Singapore is very good at doing. They like things to be peaceful and calm. They are an importing nation, so anything that is disruptive to the global economy will ultimately impact them. That's sort of his message, and he's just sort of saying to people, just be warned that if this continues to happen, then it might have an impact on Singaporean goods and services and pricing. So I think that's a fair message, but you're right, it is unusual, and I think you should take it seriously when countries such as Singapore, which does have a very good economy, um, they have a very good philosophy that this generation will never pay for the next generation, and the next generation will never pay for the generation before it. So that they have all of these funds and investments in place which should always allow for that to happen. I think these sort of comments are sort of probably showing some concern for the future and how that may impact down the line.
Could this, or you know, the way this architecture has sort of unfolded in the last 2 weeks now, where China is a little bit isolated, everybody else has got their 90 days, China's up at 150% of tariffs. Is it possible that the U.S. strategy could create a wedge between China and Vietnam? And we see the Chinese leadership in Vietnam today and yesterday. How does that play out? Is that given how wedded the economies of Asia are?
Is that to me?
Yes.
Yeah, I would say I look at it the opposite actually. So what we're actually seeing is China's particularly starting to trade and partner with places like Japan and Korea and Taiwan, which is something culturally you wouldn't expect a few years ago, but that's certainly happening. I think you can see to the point earlier about the robust income of flows into China of oil from places like Iran and Russia, just shows how adaptable they are to changing things. So I think it's actually, and the fact that Trump's also allowed iPhones back into the country untariffed, and I think there was another announcement about other appliances today. So what is the real damage? What are the big imports that are going to get impacted by tariffs, and how much of that is just going to make China start dealing with other people and create a new world order? It don't want to sound like a drastic.
Well, to sort of put wind to the sails of that
Yeah.
kind of BRICS, Global South, all of these sort of new economic blocks, whether formal ones like ASEAN or informal ones like the BRICS. Daniel, looking at, again, coming back to the OPEC Plus decision and where Saudi Arabia's ability and other states to hold the line here on increasing supply into a weakening demand backdrop. The comparable period that I think a lot about is the late 90s, when they did the same into the Asian currency collapse and oil prices fell, lost half their value, a bigger, lower nominal point, but still half the value, $20 to $10. And on this occasion, where we've made a drop, is this a strategy? Is this temporary? Can OPEC Plus, again, one has to ask, does Kazakhstan end up staying in OPEC Plus, or does it leave, or does it concede to Saudi? Where do you think this goes?
Yeah, I mean, you could compare it, I guess, not quite like for 2020 either, when we had that kind of market share war, when you saw negative pricing. The risk of a disorderly fallout, I think it's not our core view, but clearly there is greater annoyance, if you like, with some, well, Kazakhstan in particular, but with these countries that are overproducing. And they do run the risk that they overplay the hand, that they pump too much in, but these countries don't come to heel, as it were, and then just decide to leave, and then where are they? You have all this excess supply coming on, even greater in greater excess than we currently anticipate. So yeah, we did put out like when we revised our forecast, we did mention the risk of this. We stressed it wasn't the core view, but given that seemingly kind of disagreements within the wider bloc are becoming more aggravated, it is a tail risk to look out for, I think.
Let's go to the survey question, which is looking at this point. Kazakhstan is still producing 400,000 plus barrels per day above its OPEC plus commitment. That's above quota and their compensation cuts, without getting too in the weeds of the numbers, but ultimately 400 plus more than they should be. What will most likely happen next? Kazakhstan leaves OPEC plus, follows Qatar out the door, Angola out the door, and continues at its current levels. I mean, it's up to capacity of 1.8 million barrels a day, and probably needs every dollar. OPEC plus abandons quotas. We're in this increased supply piece, and do the OPEC plus abandon quotas? Kazakhstan stops cheating. Is that a most likely next step? Or OPEC plus keeps raising supply as they did this month by a little bit? And Russell pointed out that the numbers would show that it's not even net a lot of an increase this month, but next month it's triple the number increase of this month. And does that continue to keep raising supply beyond May, June, and so forth? So which of these four do you think is the likely next thing to happen? Kazakhstan says, halas, I'm out of here. OPEC plus abandons its quotas, etc. You take your point there. Kazakhstan stops cheating. Ole, taking the moment to look a little bit closer to Europe, some really nasty stuff happening in the war in Ukraine. Russia seems to be really stepping up. The horrible phrases, spring offensive, like it's some kind of next episode in a Netflix series. But ultimately, after the big momentum of the Trump administration's appetite for resolving this conflict, there doesn't appear that seems to have lost some steam, or are we just not seeing it? I mean, there are these meetings going on. Where does Europe stand, do you think, at this point in terms of its ability to ensure the outcome in Ukraine is where they want it rather than where Putin wants it?
Well, in the short term, challenged, I think it's fair to say, with the lack of support from the US right now, but I think overall, simply that the agreement that Trump is touting is really Trump's agreement, and that is just simply not palatable for Europe. So that basically means that the support, I think, remains firm and will continue. Where this ends, you kind of fear there's going to be a Korean style, no end to the war, but some kind of stopping the fighting, but not really finding a solution, because obviously that would basically mean that no one have to declare a victory or defeat. But I think the resolve in Europe is very strong, and we obviously has had a major wake-up call with the lack of with Trump scaling back, or the US scaling back support. So it will obviously take some time, but I think.
And at these prices, of course, essentially Russian crude is no longer sanctioned. I mean, it's trading well below their price cap at 60, unless there's some reports that are looking at maybe lowering that price cap.
Yeah, there's still something that can be done, and we'll see. But Trump is mostly focused on getting the win. It doesn't really matter with the details, but I think at the same time, we will, if we don't see any changes from Putin's stance, then potentially could lead to a greater deal of frustration from the US, and that potentially could add things along. But for now, it's a stalemate, and yeah, obviously some concerns about this so-called spring advance has been talked about.
Russell, last word for you in terms of where do you think the possible source of giving this oil market some new direction? We kind of were stuck at $75 barnacle on Iraq for a long time. Now we're at 65 with whatever way we got here, tariffs and OPEC plus supply increases. What do you think or could come on the horizon as we go into the spring-summer period? Driving season in the US, typically a big demand window.
So 75 was a number, but to me, the big number was just above 70. And we plowed through that very hard. To the point earlier, the bond market's been really interesting, the treasury markets. They got absolutely slammed in US hours to the point where I heard the brokers saying this thing's broken. So I think oil had some of that in it too. I'm still confused why OPEC decided to announce at the same point of doing that at the same time Trump was doing these things. So that's the question in my mind. So I think the market probably a bit away from fundamentals right now and just sitting there waiting for the news trade, sell the rumor, buy the fact type stuff. So I'm expecting 70 to become a bit of a ceiling now. And I think a few people talked about this early on in the year, was like this move out from the 70, 85 range into the 60, 65, 70 range. And I think we've found that in not the way we expected, but we're there now. And I would be surprised if we see Oman particularly get back above 70, because that was a very big level to break through and it did it hard.
Yeah.
So all of the fundamentals don't really lead much to.
Well, the
being
announced
overly bullish.
OPEC Plus are going to be facing again another decision in the coming 2 weeks about May or June plans. So that will be interesting to see if they sustain. According to our survey result here in this room, they expect that OPEC will keep raising supply. Daniel, last word to you, as brief as you can be, on a very big subject, but the old chestnut. I mean, given the stress we're seeing and language and headlines of that the treasuries are no longer a safe haven, the question about the dollar, of course, all of that very relevant to the Gulf states. We're pegged to the dollar here. Any tremors felt from that here?
Not that we're seeing as yet, but obviously it has implications for trade. Like I was saying, could be more attractive, but imports more expensive. So certainly something that we have to keep an eye on, and equally what the Fed's going to do. Are they going to cut 3, 4? I think market prices come back towards 3 as well. So not seeing any fallout as yet. We had a pretty good MBIL auction yesterday, but clearly something we're keeping a close eye on.
Yeah, it's certainly one of the, it's been creeping up on the inside lane for a few years now. At what point does a US debt at $36 trillion and a leadership team behaving like they're taking over, some unpredictable state in an emerging environment? It's the combination of the two, I think, erratic leadership and $36 trillion of debt, with a deficit this year so far already above $1 trillion in the US, and tax cuts to come. It all looks a little bit frightening. Ole Hansen, thank you so much as always. Great to have you back. Daniel Richards, Russell Robertson, thank you so much for participating today when Brent crude oil is up a little bit, getting a little bit of a heartbeat at up 0.5%, breaking through $65 a barrel. What will move it out of this number? We'll have to wait and see. Thanks, everybody. Have a good day. Bye-bye.
Thank you.